Hello, everyone. I'm Rick Bensignor. Today is April 7th, 2020, and welcome to this week's In the Know Trader Show. Well, after yesterday's 7% plus gain in the S&P 500, as we record late morning today, it's followed up by another, it's up over 1%. It's well off its highs. It was right now the S&P is about 2692. It had a high of 2757, not too far after the open. So it's actually come off quite a bit from then, and you're seeing some real buying having come in the last couple of days. We'll talk about that a bit as we get into the show. Let me just remind you that in order to get my calls on the S&P, what's going on in the market, the bond market, gold, the dollar, et cetera, the kind of the big macro stuff, along with a new ETF trading idea each week, go to intheknowtrader.com. Actually, it's not sign up. Go to intheknowtrader.com. I'll fix that slide for next week. Just go to intheknowtrader.com and then find the sign up tab. And that's where you can sign up for a subscription. To contact me, it's rick@intheknowtrader.com. This week, we're going to spend the bulk of our time looking at the consumer staples sector of the market. This is the second best sector year to date. And we'll take a look at, I guess, about 10 or so of the biggest names in the sector: Procter Gamble, PepsiCo, Walmart, MDLZ, Philip Morris, Costco, Altria, Colgate-Palmolive, and Kimberly-Clark. I will start off just here. Actually, let's go to taking a look at the year-to-date macro sectors. These are the 11 sectors of the S&P 500. And you'll see, unlike last year, you've got the bulk kind of concentrated between +7 or so percent outperforming to -7% or so underperforming. The big outliers on the downside are energy. Energy is, as of last night, down 29% versus the S&P's performance this year. It was significantly lower than that just a week or two ago. So energy has gotten a good relative bounce, but it's still the dog out there. Financials, the second worst, down 13.5% relative to the market. And the best sector is technology, up 9.34%, or as we say in the industry, 934 basis points of outperformance, followed by staples at 9.23. And the reason I picked staples to take a look at this week is because they have performed very well this year. And depending upon what your outlook is going forward for the markets, it's definitely a sector you want to have exposure into. It is a defensive sector. It has always been a defensive sector, which means when the market goes down, it goes down too, like all stocks, right? A bear market is going to take all stocks down, but it almost always takes staples down less than the rest. So this is a sector in difficult times, as we're in the midst of, regardless of what the market's done the last 2 days, that you want to have some exposure to. So we'll take a look at those names and kind of give you a sense of where you might want to be buying those names, as well as where you might want to be lightening up on them in absolute terms. So we'll look at the charts of those names to get a sense of that. Let's start off. Let's go to our charts now. And here's just a simple old candle chart of the S&P. And I'm not going to go deep into it, but what these are two trend lines here. I'll actually bring in some more data here. Let's see. So if you see back, this is this lower line here started from the Christmas low of 2018. The other one was from the summer of 2019, the June low. So those are potential resistance points, you know, when and if we rally back. But more importantly, at least over the shorter term, without adding other models on March 23rd, I was the guest host on Bloomberg TV in the morning, so I was on for a full half hour with the anchor, Alex Steele, and that was the day that we said we were buying the market. And then last week, and the No Trader clients know that we said, so here's, last week, in fact, it was, I guess it was last Wednesday, was April 1st. And the market had a significant down move that day, you'll recall. And that's because the end of quarter rebalancing was done and all the buying that was likely coming into the market was done. And the street kind of knew it. So people pounced on the market to start the new quarter. And by the close of last Wednesday, April 1st, the consensus was that we were going to test, if not exceed, the bottom. Down from March 23rd. And that's the same day I put out the In the Know Traders weekly tactical trader report to my subscribers. And that's the day that we said why the test of the low was unlikely going to happen and that we would likely actually trade higher. And this is obviously what we've seen since, with targets initially between 2650 and 2750 and then well higher. So the reason I mention this is you have the opportunity as a listener to this to also understand how and why I came up with the call both on March 23rd for clients as well as last week's low. And that's why you subscribe to In the Know Trader, is to be able to get information that is based upon institutional models that the public generally doesn't have access to or understand how to use. But myself, I've been doing this now, dare I say 40, that's 40 years I've been on the street. And this is what allows me, the models I use in my interpretation of them is allows me how I was a buyer on March 23rd and how we were buyers last Wednesday when everybody else was looking for a test of the lows. Let's take a look at the, let's just start with XLP. Oops, that's not going to get us there. Here we go. Here's the XLP. This is the ETF that tracks the consumer staples sector. And the easiest way for you to trade the sector completely, rather than individual names, is the XLP. Right? It's one of the 11 macro sectors ETFs in the market. So when we sold off into the March lows, you'll notice that even though we had taken out these prior two lows, it's a weekly chart, closed well off there that week over here, triple bottom, just north of 48. And that's obviously long-term important support. When you look at the sector itself, it's kind of just eyeballing this. It is approximately halfway back up. So you might very well see some resistance here. You certainly could see some resistance in coming weeks, kind of towards the top of the cloud. So in absolute terms, we're going to start running into resistance from here on up. Let's take a look at this now relative to the S&P. So here's now the sector versus the S&P. And let me take the cloud chart off just to make it simpler to start. And you can see this is the look you have here, and that basically in relative terms last summer is when this bottom versus the S&P. And this is again a weekly chart, and then we sold off again at the beginning of this year. This is what I've drawn the trend line off of, and we've moved up here. So you know what, if I draw a parallel line, so let's make this into, instead of just a trend line, let's kind of look at this and see on a channel basis. So we're kind of dealing right here. We've popped through, but we're on either side of the top of the channel. So taking out new highs here would be bullish. Otherwise, we can back and fill. But you can see the huge run up, one of the fastest moves we've seen, and the depth of the move over the last couple of months as the market fell apart, and Staples is the place people go into, right? Because regardless of what's going on in the world, whether it's politically, obviously now as far as the health concern, people still need their basic goods, and that's what consumer staples are. So you still need to brush your teeth and buy toothpaste. You still need to buy soap. You'll see as we go through these names, these are very common names that you'll see. You're still going to drink soda, although you shouldn't be drinking soda at all. But Coke and Pepsi are on this list too, as again kind of the top 10 component names inside the staples sector. So these are all companies that people use regardless of what's going on in the economy. But when times are good and you have the cyclical parts of the market leading on the upside, these will rally, but they won't rally nearly as much as technology names and financials. When financials are on fire, the staples are going to lag. So in a good, strong market, generally staples will lag, but in a down market, staples will outperform. And that's why they're called a defensive sector. So they'll partake in the general direction of the market, but they won't go down as much on the downside when you have a bear market, and they won't go up as much on the upside when you have a rip-roaring bull market. So in difficult times like this, it's certainly a sector that you want to have more exposure to than you typically do. And again, depending upon your outlook going forward, if just lay out two scenarios. If you think the March 23rd low is as bad as things are going to get, and that it's only a matter of time that the S&P can come back to all-time highs right near 3,400, then you probably just want to stay equal weight in this sector. If you think things, the March 23rd low could easily be tested in coming months or weeks, the way the markets work now, it could be weeks, it could even be days. Then you're going to want to have this sector more as an overweight. You're going to have extra exposure to this sector because in a down market, these just won't go down as much. And even though, again, they'll go down, they won't go down as much. And therefore, when you think about portfolio construction, you'd want to have more weighting in a defensive sector like this. So let's take a look at a bunch of the names here in the space. Let's start with Procter Gamble, which is the, if I remember, the heaviest weighted name in this index. So one of the things we can do here is let's switch this to a trend line, and let's grab the low, and let's see kind of, all right, so we had one Friday close beneath the trend line, but it held right to the bottom of the weekly cloud. The next week it opened beneath the weekly cloud, traded down to just under 95, but look where it closed. So as far as I'm concerned, the trend line and the bottom of the cloud are still essentially valid. Now, in the future, would I still look at that line? I would. I'd also have to look at this one just because that would be the official now lowest lows connected to each other. But what I want to look at now also is what's going on the upside. Notice that staples are not all that far away. In fact, when you look at, not staples, Procter Gamble, when you look at this, this is, as a stock, this is doing better than XLP was doing to itself. So this is actually an outperformer within XLP because you'll remember the XLP was kind of about halfway back towards its all-time highs, whereas this looks like it's closer to 2/3. So Procter Gamble is a stronger name and outperformer relative to XLP, and therefore it would be one of the better names to be in. Now, as far as just playing this on an outright basis, look for some potential resistance around 123. If we take out the highs, I'd say 130 to 135 or 130 to 134 comes next. And that would be kind of some real significant resistance here. As you massively squeeze out shorts above new highs, but there's still, you can see multiple targets up into this area. As far as buying, if this were to pull back, somewhere around 111-ish, give or take, would be first support level. And secondary support, I would now put, again, kind of at the bottom of the cloud. It matches up with that original trend line, somewhere here around, where is this, 106.25 or so. And that number is good for the next couple months. So if this does back and fill here, this is probably not a bad place to do some buying. You'll notice that the MACD has at least hooked. The two lines are coming together and started spreading apart, so you've lost a little downside momentum. You're not going to get a buy signal here for several weeks. And if this kept moving higher, by the time you did, it would be way off the lows. And that is often one of the problems with any type moving average model. And of course, the MACD is the difference between two exponential moving averages of 12 and 26 weeks. So you can see how late this would be in getting a buy signal relative to where the low is. If we were to keep going up, this would eventually cross over. But again, you could easily be right near all-time highs by the time that happens. That's why it's only, one of many indicators to look at. And in a market that's moving like this, which has gone from 95 to, let's just say in round numbers, 120 in a matter of a couple weeks, when you think of that on percentage terms and how big that is, these moving average models aren't going to help you. There's way too much volatility in the markets now to use a standard measurement like this, which works better when the markets are trading in normal ranges, not the way they're trading now. In fact, if I put up and show you, this is the average true range in dollars of Procter & Gamble now on a 10-week basis. So a 10-week moving average is at, it has an $11.55 range per week. Look at what that was just, look back any time in the past, and this thing never even got to $5 as an average range in the week. So, huge volatility now. So that's why something like a MACD is not going to serve you very well these days. Okay. Sometimes my mouse disappears when I use this into a PowerPoint, so let me just switch and come back and see. There we go. Cancel. And now let's take away this and move on to the next topic, which is Pepsi. Similar look. Notice here we're just kind of poking through the top of the weekly cloud. Will be interesting, as the market kind of settles in here after this massive two-day gain, whether or not this holds in here as resistance. If we do a retracement, let's see, it looks like we've probably, I'm just eyeballing this, but it looks like we've probably gone more than the 60. Yeah, we are well above the 62%. But you're starting to get into the area that it broke down from, right? So you had lows in here, and that's broken. So would I be chasing after Pepsi right here, right now? No, I'd probably use, backing and filling into the weekly cloud as a better opportunity rather than just simply going after it right here and right now. Resistance is just north of the highs. There's some targets up there which just failed to get to. On a real breakout, this gets to almost 153. Pull back here towards, again, the bottom of the cloud over any time in the next month or so. You get a chance to buy in this 123-ish neighborhood, I would say that's probably a better place to get it than chasing after here at almost 134. Let's take a look at Coca-Cola. Much weaker. Everything else was, playing with the top of the cloud. When we looked at the last two names, Pepsi clearly was playing with the top of the cloud. Look here how much weaker Coke is. It's probably back to its 50%. We're just about a 50% retracement right here. This potentially has cloud resistance above it in a stronger way than any of the other ones did. This is a weaker name. For those of you who know how to trade pairs, in other words, you buy one stock and you sell a similar type of company stock against it, the way I'm looking at these charts, it looks like to me that you'd be buying Pepsi and selling Coke. You're hedged that way against market direction. But just basis, there's no fundamentals here that I'm incorporating into it. I'm simply looking at the relative look of the charts to each other. Coke is definitely a weaker chart than Pepsi is. So one of the ways you can get exposure, but hedged exposure, is to put on a pair trade of two names that are similar. And again, just looking at this, it favors that if you're only going to buy one of these companies, you'd be buying Pepsi, not Coke. So targets on the upside here would get you resistance from 50 to about 53 or so, 54 over the next few months. On the downside, I don't actually see much within this chart to even look at where would be a safer place to buy. And probably, let's just take a look at a daily chart and see if there's anything here. If you don't think the lows will be taken out, I'd say 42.5 to 43 would be your, that place to be a buyer if you're so inclined to do that. But clearly, this is a weaker chart than Pepsi is. Let's look at Walmart. Walmart's been stellar. And you can see that the sell-off came right to the bottom of its cloud. And, in many ways, people will say that Walmart is the closest competition to Amazon because of the online service that they have, and the fact that you can buy almost anything on Walmart similar to Amazon. And looking at that, you can see how well the stock has done in the decline. So even though it got whacked down from, let's say, well, in February, it looks like all-time highs were at 128. It went from 128 down to 102. So again, decent chunk. But so in round numbers, 25%, not nearly as bad as the 35% that the full market had sold off. So this consumer staple did its job in not performing as poorly on the way down as the rest of the market did. It's also done phenomenally well on its recovery, that if we were to close out the week right here, you'd be closing on the highest Friday close, the highest weekly closes they've ever had. Let's disregard the fact that this Friday is Good Friday, and therefore the market's closed. But just obviously, you can see this would be the best close. So this is a stellar all-star name within the group. There's very few we're going to look at that are close to all-time highs. So as long as there's still concerns out here, Walmart still seems to be a name that's going to perform well, and it does mean it won't get pullbacks, but I have much less fear that these lows will be taken out than some of the other names that we looked at or will look at. MDLZ. By the way, sequential 13 right near the top, the collapse. For those of you who know how to read cloud charts, even though price broke beneath the cloud, the lagging line here in blue actually went exactly to where support would be. This is now going to have some resistance. Again, we're through the 50% retracement. This is not going to be the top of the cloud for the next couple of weeks. Is not going to be far from the 62% retracement level. So again, I might not want to jump too much after it. Look for pullbacks within the cloud. I'm not sure we're going to go all the way down to the bottom end, but at least instead of paying in the low to mid 50s, my guess is you'll have a chance over the next couple months to get this at a better price than it is right now. Philip Morris. Okay, totally different looking chart. Not anything close to its all-time highs, which were done back here in what year is this? 2017. So just all in all, when you look at this chart, you know, this is the weakest chart we've looked at of anything. Let's see if it's still within the context of the downtrend. Well, no, yeah. So all we can do is versus this year's high, but this is a weak chart in general, not a name in particular I'm going to love. Now, it does basically have some type of double at bottom, but in my view, and the stock's, let's see, 93, you'd probably have to get above 97 and change and stay above there for me to even have a chance of liking the name. So this is just, out of everything we've looked at, this is the weakest chart there is. So no reason to pick this one as the one to go into. Costco, one of my favorite stores to shop in. Although these days I hear you could wait in our local Costco. On Sunday morning, people waited 3 hours to get into the store. So all the recent lows against the top of the weekly cloud. That's why I am very much a fan of this particular model. This not far from its all-time highs. Now it is in another week or so of strength. This could get potentially another exhaustive signal, a 13, which means it's going to be hard for me to buy it. So the fact that this held up as good as it did and only pulled back into the same range that we've seen since last summer, which puts this as one of the similar to Walmart in the sense that it's a stellar name. Here again, I have much less fear of this taking out the recent lows. And in this case, the low was actually in February. It's not the March 23rd low, but it was actually made in February. But this name is generally a good one, and I think that with recovery, and if you can get more and more people back into the store, we should get to 324 and 339. On the downside, things would have to get really ugly for this to take out and make new 2020 lows. But for longer term investors, if you get a chance near 250, the bottom of the cloud sometime this quarter, that would be a place that I would say is probably worth putting some exposure on. Let's take a look at Altria as we starting to wind down time here. Altria also similar to Philip Morris, crappy name, straight downtrend, any channel. Yeah, it bounces off of weekly nines. You can see lots of them that were interim lows. But again, no real particular reason to pick this name. Almost everything else in the space is better. Nope, that's copper. Sorry. Oh, wrong signal. This is, sorry, I don't have the right ticker here. Let me go. The last one is KMB, Kimberly Clark. Like several other ones that we've seen, kind of middle of the range, slightly better than middle, poking through the top of the cloud. Look for resistance up to just a little higher than here. Same thing. Don't really want to chase after it. Rather buy sometime in the next month if we get a chance, somewhere into the cloud. So that's it for this week. Hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.